Welcome back to Revenue Roundup podcast, hosted by Water Company of America. I am Shane Sangali. In this episode, we're going to jump away from the utility revenue discussion and into the world of municipal bonds, the short-term economic outlook, and what that means for municipal government. We have with us today David Webb with Stifle Public Finance out of Houston. David and I have gotten to know each other a little bit over the last month, year or so, at the Government Finance Officers Association of Texas Gulf Coast chapter luncheons. Get together once a month, all of the finance officers there in the Gulf Coast, and have a speaker and share topics that are related to the industry. And then sometimes we get together and play a little golf afterwards. And so that's kind of where David and I really have gotten to know each other, is on the golf course. So welcome, David. Glad to have you with us.
Thank you. Happy to be here. A little bit about my background. I spent 26 years working in administration for school districts, finance administration. Minored in economics in college. I'm not sure it helped me a lot to understand the economy. I probably learned more about it, like you and everyone else has since then, by just observing what's going on. And that's a topic that I kind of keep my ear close to the ground on. 10 years ago, I retired from school finance and went to work for Stifle as a bond underwriter and municipal advisor. It's been very different from working in school finance, but very rewarding, very enjoyable work. And, I do a lot of economic quarterly updates for our various clients. And so this is a topic I have a lot of keen interest in.
Thanks, David. Appreciate you introducing yourself, giving us a little background. So let's just jump right into it. Let's talk about short-term economic outlook. I know you're going to talk a little bit about bond elections and bond refunding and things like those. Walk us through that. What does that look like? What does that mean to municipal government? What does that mean to the citizens, the taxpayers, the lay people like ourselves, if you will, that are not involved in that on a daily basis?
Well, number one, Shane, I think the big issue on everybody's mind economically, globally right now is inflation. And I've heard some young people, I'm 65, so almost everybody's younger than me, but I've heard some young people who weren't around in the 70s say, wow, this is the worst inflation we've ever had. And if you look on the internet, it'll say worst inflation in 40 years. Well, it's the only inflation we've had in 40 years. I'm old enough to have been a teenager in the 70s, and I remember that was inflation. That was very serious inflation. That was 18 to 21% inflation. That was sitting in long lines at the gas station. That was shortages of items at the grocery store. If you could get them, they were overpriced, and a lot of times you couldn't get things because the shelves were empty. That was concerning. Even as a teenager, I knew that this is not good. Now, we've had a lot of economic stability over the last 40 years, and for the first time since those 70s, we've got noteworthy inflation, and everyone's concerned about it. What I would say from a historical perspective is, really, this is not as serious as the 70s. It could get there. It probably won't, but it's certainly not worth pressing the panic button over. Yes, prices have increased. Economic indicators that drive inflation up have increased. I'm not yet concerned about inflation unless it looks like it's starting to get out of control. Part of the impact of that inflation on the bond market, Fed rates have hiked over the last 18 months. That has driven up bond prices, and that's my business that I pay very close attention to. And part of the fallout there is bonds that could be potentially refunded at lower rates, much like you refinance your home or would refinance a car note when interest rates change. That party, at least for now, is mostly over. We've done a lot of that. In fact, refunding of bonds, existing bonds, has constituted about half of the market in Texas over the last couple of years. That's not going to be the case in 2024, and it wasn't the case in 2023 either. So, my message to most people out there would be stay calm. Inflation is never good, especially when it ramps up quickly. But you think back to the pandemic and all the PPP money and all the other financial aid that came out of the federal government, we quadrupled our M1 money supply. When you have basically the same number of goods and services out there in the market and you quadruple the money supply, price of things is going to go up.
Right.
And in fact, it took a long time for it to go up, but that was a very logical consequence of having all that money flow into the economy and quadrupling of the money supply. I actually expected inflation to be worse than it is. I expected some shortages at the grocery store and other places where we buy goods and services to be worse than it is. In fact, the one place where it's probably hit the hardest is in the construction market, where wood, concrete, steel, wiring, and electrical supplies are not always easy to get. You, as a governmental issuer, may have money that you want to spend on a project, and that project may be sitting empty with no workers working on it for a couple of weeks because you can't get the steel, the concrete, the wood,
Right.
the electrical parts and plumbing parts that you need to continue. So that I see has been a big impact on the bond market per se as a result of the inflation and the supply shortages.
Go ahead. What you got next?
Yeah, more drilling down into more detail. What the Fed is trying to find an equilibrium point for this economy. We had inflation that kind of acted like it was going to get out of control, and they're trying to bring that down to what is very much equivalent to a soft landing of an airplane. You know, when you're making your approach to Hobby Airport, you want that plane to land pretty softly. You don't want them to slam it down real hard and shake everything up. What they're trying to do in finding an equilibrium point for the economy is very similar to that. They don't want to land it too hard, but they do have to land it. And so at some point, there's going to be at least a little bump. And the way the Fed manages that is with interest rate changes. They have been hiking the interest rates for almost 2 years now. Now, in November, after saying early in November they were going to raise rates one more time, a couple of weeks later, right before Thanksgiving, they said, nix that. We may draw rates down 25 basis points once or twice in early 2024. That was a surprising about face, but welcome news. So I expect to see the Fed lower interest rates about 25 basis points fairly soon. Probably an announcement coming out about that fairly soon, and then maybe another time before we get to summer or midsummer. Now, that's good news. That's good news for all of us who are consumers. That's good news for a lot of my clients who are in the construction business after they pass a bond election and sell bonds, because now they are looking at lower interest rates. They build schools, city halls, jails, roadways, water and sewer treatment plants, the same way you and I acquire a house. They're going to put up some money for it. They're going to pay interest on that loan over a number of years and do the construction and the payment of the debt being two different things. Hopefully they both coincide as far as their useful life. And I'll touch on that in a little bit. And so, you know, what they need is economic stability, both in the supply sector and in the financial sector. If rates are up and down all over the place, then they are tempted to play the game of, when do we sell our bonds? Do we watch the market, play the market, and try to sell when rates are low? Do we avoid selling our bonds when rates are high? Most of the time I tell them, sell your bonds when you need to sell them. And if we sell them at a high rate, we can refund them later. But do what you need to do. Unless you're a financial and economic expert in the market, you don't need to be playing the market. People go broke doing that.
Good deal. So I guess back in I guess it was November, we had bond elections throughout the state of Texas, right? So, but yeah, if you want to hit on that a little bit, it'd be great.
We had a lot of bond elections on the uniform election day. In Texas, we have bond elections in May and November only on the uniform election dates for those months. And in November, I saw some very predictable results. Cities and counties passed at an extremely high rate. School districts passed at a good rate for a November election. Not all of them passed. And I know the ones that failed, I know that stings. As a CFO for a school district, I was 5-1 on bond elections, passed the last five, lost that first one. And that one's back in like 1991 or so, and it still stings because it didn't just fail; it was slaughtered.
Oh no!
And it always hurts because there's a lot of work that goes into these elections. So I feel really bad for the school districts who legitimately need money for their bond projects and have not done what they needed to do to convince the voters to give that to them. But overall, it was a good day for school districts. I'm beginning to see some trends that probably started prior to the pandemic. Typically pass at a pretty high rate. Counties pass almost 100%. MUDs and other specialty districts pass almost at 100%. The caveat there being there may be a MUD, a municipal utility district out there that will pass hundreds of millions, if not $1 billion or more bond election by a 1-0 or 2-0 vote. That's
right.
Yeah. That has always been curious to me. I think I have some reservations about that, but it is what it is. If that's all the voters you have in that district, and they're the ones who go to the polls, then, that's democracy. But that MUD business is very different business. What we see with the school districts is very different. We can have an election cycle where there's a high passage rate. We can have another election cycle right after that, 6 months later, that is alarmingly low. And the things that are having difficulty passing, some of it is regional, some of it is topical. Topical items are stadiums. Stadiums are just a hot topic issue right now. Voters are not amenable to spending $100 million on a football stadium. They're just not. They've done it before. It's got some bad PR. Those are having trouble passing. Anything that is other co-curricular, like a swim center or track and field, all of those athletic facilities are struggling to pass. All of those performing arts centers, anything that might be band, choir, orchestra related, those are having trouble passing right now. The things that are passing are new schools, major renovations to old schools, and anything that is security or controlled access related to the school.
Right.
If you've got an old school and you need to build a new foyer onto the front of it to control access for people so they can't just walk into the school and go knock on a classroom door, those are passing at a very high rate right now. Regionally, what we see is there are some places where it is difficult to pass an election. If you look at the triangle between Houston and San Antonio, Austin, Waco, all the way up to Dallas, that triangle right there, those three major metro areas are passing at a pretty high rate. You get outside of that triangle and it gets more difficult to pass elections. You get more rural and conservative in those communities, and some of them are not always agreeable to giving the school district more money. And then also regionally, anything that you would call East Texas. And East Texas to me is east of Interstate 45, pretty much from Beaumont all the way up to the Red River. That is a different world. And school districts in that area are having an enormously difficult time passing bond election for anything. Now, this last November, that area did better than usual, but not everyone passed, but it was a higher passage rate than usual. It just probably wasn't what everyone wanted up there. But that area historically has been very difficult to pass a bond election in.
You hit on that a little bit, conservative, a little bit more conservative there. Are there other things, other factors that kind of contribute to why that makes it more difficult? Is it just a mentality of, the good old boy? Well, David, if it ain't broke, don't fix it, right? It's worked for 100 years. So why do we need to make any changes? Is there a little bit of that goes on?
Yeah. In some of the
Yeah.
rural areas, you have people who've lived there all their lives, and their thought is, if that elementary school was good enough for me, it's good enough for my kids or my grandkids. Well, education has changed in the last 50 years, and there's a lot more technology, and these schools age, the foundations shift.
Yeah.
They're not wired for the computer technology that is in the classroom these days. And in 50 years, pipes corrode. And, at some point you get to the point where you can't renovate a school. It's cheaper to tear it down and rebuild it. But, in some places you've got, it's an antiquated term now, but Tea Party activists. They don't care what the money is for. They don't want any more new debt. It just end of sentence. There's no argument. There's no discussion. We just don't want any more debt. End of argument. And they're not going to vote for anything. And there are still pockets of those groups out there. And those pockets seem to be bigger in East Texas.
Gotcha. Yeah. Makes sense. It makes sense. Right. Most definitely the growth. I don't know if you want to say the forward thinkers are in the triangle that you're talking about, right? That's where people are moving to. That's where people are taking their families and starting to raise families in those areas because there's just more opportunity for them. Where are we at with bond refunding? You want to touch on that a little bit?
Yeah. We touched on that earlier, but to expand a little bit, the bond refunding party, at least last year and so far this year, appears to be over. I think the trend I'm starting to see is instead of refunding existing debt to a lower interest rate for the same period of time, I'm starting to see more and more issuers, cities, counties, school districts at the top of that list, pay off some debt early. They may say, we've got a little money in our debt service fund. Instead of refunding some of these bonds that are now callable and maybe saving a little, let's just pay them off. Pay them off now, be done, let's save a lot. I'm seeing more of that. I saw more of that in 2023. I'm seeing more and hearing more discussion about that sort of thing here in early 24. I've got a couple of clients who are looking at that as an option. And I think that's going to be the new refunding party. And that may change. If rates go down 25, 50 basis points, suddenly there's some debt that will look refundable that wasn't a viable refunding 6 months ago. So we may seesaw back and forth between paying off some debt, refinancing. I don't think we're going to get back to the point where refinancing is 50% of the market like it was a couple of years ago.
So again, question. We've talked a lot about debt. We've talked about rates. We've talked about refunding. So, the question, I guess, is how much debt is too much?
I had started to hear that question here the last few years. There are even people in my business. We make our living off of cities, counties, school districts, other municipalities issuing debt. I've even heard people in my business say, wow, are we getting to the point where we're saturated? How much is too much? Well, first of all, I would say in a state like Texas that is growing at a pretty substantial rate over a sustained period of time, that means more people going to school, more people, unfortunately, going to jail, more people using the roadways, new developments where you need new roadways and water and sewer. There's a lot of infrastructure that goes into accommodating an increasing population. If you're buying school buses and you're financing them with bond money, if you're amortizing that debt over 10 years, which is the average useful life of a school bus, I'm really not very concerned about the total creeping up and up and up. As long as you're paying that debt off as those assets begin to retire. If you're financing technology infrastructure and you're financing it for 5 years, then I think that's good. You're building new schools, new city halls, new administration buildings, new maintenance facilities that are going to last 30 or 40 years, and you're paying for them over 25 or 30 years. I don't see a problem there. The numbers may get bigger. You may have more zeros on the end, but as long as those assets are matched to the life of the debt, I'm really not very concerned about what the grand total is. Where I get concerned is where I see one of these issuers spending bond money on technology and amortizing that debt over 15 or 20 years. There isn't any of that technology that's going to be viable in 15 or 20 years. So you're still going to be paying that debt when those assets are long gone. That I have a problem with. I don't see a whole lot of that out there. In fact, I see very, very little of that. Probably so little as to be negligible and immaterial.
I agree with you. We don't see it near as often as we used to. These cities that are going out and issuing a bond for a water meter changeout project or an AMI upgrade where they're putting in this new technology and they're paying it out over 15 or 20 years when these water meters weren't designed to last 15 years. This technology is changing every 2 or 3 years. And so by the time they pay it off, they're already outdated. It's antiquated. They got to do it all over again. And most of the time it's before they've even got the thing paid off. We're not seeing that as much now. Go ahead.
I was going to say, the last thing you want is to have a client who needs to buy new water meters and has to do it with bond money, but they're still paying on the old ones that are outdated.
That's right.
And retired. That's not right. That's not good public policy. It's not good business. So you want those bonds for that kind of work to be on a very short amortization schedule. And I think we're seeing more of that these days. That equipment's not going to last 15 years. So you don't want to pay for it over 15 years.
That's right. Exactly. We're seeing more and more suppliers, service providers and stuff that are now offering some meters as a service and financing that type of stuff in-house where it pays itself off in 2 to 3 to 5 years, if you will, because they know that's what's going to happen with that stuff. So seeing a lot more of that trend. So
that's all great. A bigger issue here in the coming years is that sort of thing. As we get more technologically innovative, and we've got meters that read themselves and transmit data without someone having to go physically read them or just drive by. I think that issue of how do we finance it and for how long do we finance it will be a bigger and bigger issue.
Man, that is some great information that you've shared with us today. I really feel like you explained a lot of what's going on out there in the municipal world to those of us who don't see it on a daily basis very well. Gave us some insight on to some bond elections, some bond results, refunding, and really what I think most people are most concerned about is where are we headed next, right? What's what this short-term economic outlook that you talked about? So, if you could, kind of everything that we talked about, maybe your personal opinion, if you got an overview or if you could wrap it up in a short statement, what does this mean to, number one, local government, and number two, the citizen, taxpayer, ratepayer person out there?
I think the bottom line for all of us is we're going to have to be patient and flexible. We're in a situation that we really haven't seen in our lifetimes before, where we've got a little inflation. We got a little unpredictability. We've got some shortages at the grocery store, some shortages in the construction industry. Not unusual, but maybe at a higher rate than what we've seen before. We're going to have to be patient, and we're going to have to be more flexible than we've had before. I think when you hire a contractor to go in and build water and sewer infrastructure, gone are the days of having a contract that says this project will be complete by such and such a date. Nobody can guarantee that anymore. So we're just going to have to be flexible and get it done when we can get the materials to install. I think we're going to have to be more flexible with our economy, For the first time, I did see shortages at the grocery store last year. That was alarming to me. Buy alternative products. You can't fix it right then and right there. So we're going to have to be patient and flexible. And I think those who can do that, who can make themselves be patient and flexible, or who are that way naturally, those are the people that I think are going to have an easier time and thrive in the work world in the next decade. Those who can't are going to struggle. They're going to beat their head against a wall. They can't break down. We've got a lot of circumstances brewing that make for a very unique environment that we haven't seen before. So we're just going to have to play it by ear, be patient, be flexible.
Excellent. Great. David, thank you so very much for joining us on this episode. We appreciate it. Again, great information, and I know our viewers, our listeners are going to be able to glean a lot from it. So thanks a lot. I'll see you soon down in Houston area. Hopefully we get some good, nice weather coming up in the next couple months so I can get out there. We can get on the golf course.
All right. Sounds good.
Sounds great. Thanks, Dave.
Thanks, Shane.
Hey, you guys stick around. We got a quick word from our sponsor if you want to hang on for just a minute. Good talking to everybody. See you soon.
And now, here's a word from our sponsor.
Does your utility find itself consistently battling a financial shortfall? Are you constantly having to raise utility rates just to cover costs of operations? You may be experiencing a phenomenon known as LRS, Lost Revenue Syndrome. You are not alone. Even the best managed utilities suffer from the effects of LRS. Water Company of America can help. Since 1989, Water Company of America has specialized in locating, assessing, and correcting problem conditions in utility billing and operations, thereby increasing utility revenues and easing the pain of LRS. See what Water Company of America has done for some of our most recent clients. LRS is real, but you don't have to fight it alone. Reach out today to see how Water Company of America's no-risk partnership can help your utility eliminate LRS.